Hi, welcome to DayTradeToWin. The Japanese candlestick charts are one of many different types of charts that are available to traders. The Japanese candlestick charts, or just candlestick charts, are probably the most popular ones. They're easy to read, you just need to learn the basics that we cover in this video. The candlestick chart consists of red and green candlesticks, or candles. These are arranged one after the other in your chart, and each candle corresponds to a time period, which means it shows the trading that happened, for example, during 5 minutes. It basically sums up the trading during that time in one candle. You know where the trading started during that time, you know how high the price went, how low the price went, and where the trading ended. So one candle is the battleground between bulls and bears, and it's like a tug of war. Your chart can be based on, for example, 1 minute, 5 minutes, 15 minutes, 1 hour, 4 hours, and so on. Those are perhaps the most popular ones for day traders, but the chart can be based on any time frame, like 3 minutes or 37 minutes if you want to go crazy and use something that no one else uses. This means that each candle corresponds to 1 minute or 5 minutes and so on. The candlestick charts give you an immediate overview of the market. If the candles are green, the market is bullish, meaning more and more traders are buying than selling, and if the candles are red, then the market is bearish, which means more and more traders are selling than buying. When the market is bullish, the green candles are stacking up one after the other and trending upwards, meaning the market is trading higher. The candles are generally closing higher than the previous candle. Likewise, if the market is bearish, the prices are trending downwards and candles are generally closing lower and lower than the previous candle. So let's take a look at the anatomy of a candle. The candles give you some important information. First of all, you will see the price where the candle opened, where the trading started for that candle. If the candle is green, this point will be the lower horizontal line of the candle's body. If the candle is red, it will be the higher horizontal line of the candle's body. I hope this doesn't sound confusing. Just remember that red candles are candles that went down, so the open will be the higher line of the candle. Green candles went up, so obviously for green candles, the lower line will be the open. So that's the open. In other words, the price where the market traded when the time period of that candle started. You will also see the close, which is the price when the candle's time period ended. In a green candle, the candle where the price goes up, the close will be the higher line. In the red candle, the one that goes down, the close will be at the bottom. Between the open and the close is the body of the candle. It has the form of a box, but it can also be just a flat line if the open and the close is at the exact same price level. In addition to the open and the close, you're also going to see the highest point, the highest price that the market traded at during the candle, and that's known as the high, as well as the lowest price where the market traded during the duration of the candle. That's known as the low. And these points are shown as the vertical lines sticking up above and below the body of the candle. And these lines are known as shadows and wicks. Wicks at the top, shadows at the bottom. The size of the candlestick can and will also vary. Sometimes the candles are big, sometimes they are small. Sometimes the wicks and shadows are long, sometimes there are no wicks at all. To be successful in day trading, you will need to learn what all of that means. We have many videos explaining this, so please subscribe to our YouTube channel and go through the videos to learn what that means and how you can use that to profit more. At the end of this video, you will get a link to the How to Day Trade Using Price Action video series. Make sure you subscribe and watch all those videos in that series and you will learn everything you need to know in order to be a successful trader. In our videos, we'll also teach you different candlestick patterns, what they mean, so make sure you subscribe and watch those videos. Okay, so that's how the candlestick charts are formed. In day trading, you want to find a time when the market is trending upwards and then enter your trade. In this case, you would buy. If the market continues upwards, the prices will become higher compared to the price where you bought, and higher prices means that you're going to profit on your trade. If the market is bearish, meaning if it's trending downwards, then red candles are lining up and you'll see lower and lower prices, then you can sell short. That means you expect the downtrend to continue and you would enter your short trade. If the market continues downwards, you're going to make a profit. That's trading based on candlesticks in all its simplicity. If you get good at this, you can make a living as a day trader, which is what we want to help you with. We have many different day trading strategies, coaching, mentorship available at DayTradeToWin.com. Make sure you subscribe to our channel, watch more of our videos to learn day trading. Until next time, good trading.